Ladies and gentlemen, we need to slow this down for a moment, because what is happening in the gold and silver markets is being completely misreported. Over the past 2 years, something unusual has been unfolding beneath the surface. Not on CNBC, not on your trading screen, but deep inside the plumbing of the global bullion system. Since early 2024, a quiet shift has been taking place. One that's forcing real metal to move, not just paper contracts, not futures, not leverage, physical gold. And with every passing month, the cost of maintaining that system has been rising. Now here's what should get your attention. Even at today's prices, gold near record levels and silver trading in the low 90s, sellers are still holding back, which tells you something very important. The price you see on your screen is no longer clearing the market. And while Western funds are dumping casino chips, something very different is happening on the other side of the world. On the Shanghai exchange, where metal must be fully paid for and physically owned before it can trade, buyers are stepping in aggressively, absorbing supply, locking in delivery, and setting prices based on reality, not leverage. So in this video, we're going to look at why the physical market appears to be taking the lead, why the COMEX is increasingly reacting instead of setting the price, and why what looks like chaos on your screen may actually be a transition. But you don't have to take my word for it. Today, you'll be hearing directly from British whistleblower and renowned precious metals analyst Andrew Maguire. In this interview, Maguire lays out his outlook for 2026, what he's seen inside the physical market, why pressure continues to build beneath the paper system, and why he believes the coming move in gold and silver may catch most investors completely off guard. He doesn't speak in headlines. He speaks from decades inside the bullion market itself. Before we go into it, if you value these deep dive breakdowns, please take a moment to like the video and subscribe. It helps this information reach others while it still matters. And I'd really like to hear from you in the comments. Are you holding physical gold or silver right now? And do you feel confident in how you're positioned? Or are you still relying on paper exposure and starting to question whether that difference could matter sooner than expected? Share your thoughts below. These conversations are important. Now, let's go straight to Andrew Maguire.
If you recall, that every single month since the Shanghai Futures Exchange opened in March 2024 and all the way up through, and this was the same point on the spot daily chart, every single month without fail, it's forced the Fed to repay billions and billions and billions of dollars of gold back sequentially at higher and higher and higher prices. And because spot gold is NSFR compliant and has to be deliverable, this gold had to be physically bought back at market. From under 2,000 at the Shanghai Futures Exchange open, and it was, I think, just under 2,000, up to the December close here, which was a pushback from breaching above 4,500 into the close here, and that was really basically $2,300 higher after being groomed back to 43.20 to market at the end of month event, at the end of year event. And by the way, looking at the widening physical to paper disconnect, this month's January market event, which will be the end of this bar here, is likely going to force significantly more buying, at least $500 higher than in December. Also, based on extremely reliable first-time liquidity provider feedback, I will expand on why dollar price gold at 4,700 and silver trading in the low 90s is still far too underpriced to bring anywhere near sufficient physical gold and silver to market to meet global physical demand, telegraphing significantly higher prices in both instances. Much as we estimated at the beginning of 2025, 4,500 gold and silver to blow through 50 resistance, which when it did, triggered a very large amount of short covering, and it moved into $80 and on its way to its next higher staging point of $140. Just bring this down a bit so you can see. And that is the next target point. Well, staging point for the next rally, all very similar to what we saw at 80. We will also look at best estimate supply-demand 2026 expectations for the end of year 2026. And given the billions of dollars of silver futures positions that had to be sold just to keep the casino chips, the COMEX open interest, in line with the COMEX-related commodity indexes, it raises the question, why did both gold and silver rise into thousands of contracts being sold in a short space of time? Now, I think the annual synthetic reweighting event provides the perfect example of why the COMEX is broken and it can no longer be trusted as a price-setting exchange. This is timely. They can't hide this kind of stuff. And it's historical by nature. Now, especially as in this case, because gold and silver outperformed all the other asset classes within this index, the synthetic reweighting has been forcing the funds participating in these indexes, and there are a lot of them, to sell billions of dollars of casino chips, gold and silver casino chips, just to kind of form fit the index. And it leads us into a deeper understanding of why silver is not just rising on surging bullish fundamentals, it's also rising into as yet unfactored technical bullish drivers. Now, the first thing to note is that this year's historical mid-January 2026 index reweighting technical sell call was triggered as a result of the 2025 steep price rises, which then automated technical, again, form-fitting gold futures and silver futures selling for 2026, but misses the fact that the 2025 rallies in gold and silver were not driven by COMEX-centric synthetic demand at all. In other words, the feeble COMEX tail was once again attempting to wag the very large physical dog. Now, it's not gone unnoticed by physical market participants that unbacked, unallocated 2026 index-weighted sell adjustments result from gold and silver's 2025 outperformance, which, due to just inward-facing historical weighting limits, forces technical Western COMEX selling. Now, while inversely, the physically backed SGE exchanges alongside participants, alongside global-facing commercials exposed to physical market delivery obligations, and of course long for their own books and their clients' books for that matter, continue to add fully allocated long exposure to both gold and silver into these sell events. Now, the synthetic index weighting adjustments expose synthetic paper to physical imbalances, which just fail to factor in that the global physical market liquidity has long exited Western price setting exchanges. Drilling down into this short-term volatility, the bullish clues were just all there. Now, the Bloomberg's BCOM index, which you can see here, which indicates a 2026 commodity gold index dollar weight rising from 14.291% to 14.896%. However, due to 2025 price rises conflicting with the 2026 15% capping rule, by year end, the gold futures component was overweighted by 20.43%, forcing net selling back below 15%. Hence the selling. Now, by contrast, the S&P GCCI bullish weighting was to rise from 5.10% to 7.24%, but would have also been overweight, illustrating that outdated form-fitting COMEX tail wagging the dog, the more liquid physical dog, has nothing to do with the global supply and demand prices. In other words, just some short-term noise emanating from a broken COMEX gearbox.
What Andrew just laid out is critical because it explains why these sudden price moves keep appearing disconnected from reality. On the surface, it looks like volatility. Underneath, it's pressure. Pressure created by a system that still tries to price metal synthetically, even as real liquidity continues to migrate elsewhere. And this is where the conversation shifts, because what we're dealing with now isn't just short-term selling or technical noise. It's a growing imbalance between how gold and silver are priced on Western exchanges and how they're being valued where physical delivery actually matters. To understand where this leads next, we have to look forward, not at yesterday's charts, but at what happens when that imbalance can no longer be absorbed. And that's exactly what Andrew addresses next.
$8,000 gold may be achieved as early as the second quarter, even assuming at 32 to 1, it would place silver at $250. However, setting this higher gold target aside just for a minute, given current massive silver supply shortages only exists due to a lack of enough sellers willing to offer silver for sale at paper prices, with silver now increasingly being priced based upon real supply demand fundamentals, this purely synthetic gold-silver futures ratio will be forced to reset to a physically deliverable spot silver benchmark. To achieve this, liquidity providers estimate a gold-silver ratio closer to 12 to 1, or just based on those parameters, 400 to 458 based just on current conservative LBMA gold price estimates. At 8,000, that would be $660. All at these sustainable supply demand prices, there will be a physically deliverable equilibrium silver price that will appear that will meet supply demand fundamentals. Now, this is important, and this has not been discussed. For the same reason that Basel III gold reclassifications were completely underestimated for quite a period of time, here is something about silver that has not yet been realized by the wider market. Namely, the technicals we alluded to in our earlier, which will drive the silver rally well in excess of our first pit stop at $140, this higher staging point. So for this, we need to look at the same dynamics that drove freshly recategorized first-tier gold from Basel III NSFR compliance on the 1st of January 2023, driving gold $2,900 higher to date alone. That's an increase of 162%. So just looking at that as a comparison. The reason gold has never looked back from this inflection point is because this was the first moment since 1971 where the global-facing spot gold foreign exchange market fixed benchmarks had to be physically backed. For 50-odd years, they were not. So while FX spot silver, though, is not NSFR compliant, and I'm making this point, there are other reasons, Loco London FX silver will be forced to also be physically backed. Now, even in setting aside all the fundamental bullish drivers such as silver export controls, etc., look, spot silver is now being benchmarked in the SGE exchanges where to offer or to buy silver, it has to be physically owned first and fully paid for. And it is these fundamentals drivers that is evidencing a real supply-demand equilibrium price to emerge that is in absolute conflict with the LPMCL's undeliverable, the cartel's undeliverable fixes. Now, historically, a size buyer in London or Switzerland or anywhere in the West is restricted to how much the cartel would allow you to take delivery of at that fixed price. So in prior episodes, we talked about being red flagged ourselves and threatened to be cut off a wholesale supply in the future by the cartel if placing too many orders for physical delivery in the past. And we talked about them being red flagged. However, because physical silver liquidity has flowed into the onshore and free trade zone SGE exchanges, which in turn directly connects to the Western accessible SGE gold and silver corridor, where a producer, whether a Western producer, it could be any producer, refiner, a hedger, can lock in a fully allocated physical position in any size at an SGE fixed price, i.e., put in as many orders as you can and fill them. Now, it forces the LPMCL to then borrow physical silver at a large premium, which even at $92 today, around $92, is currently at a 8.5% 1 year. That's $100. Like $92 is actually $100. It's a 1 year borrowing cost. So you have to literally, that's what you're having to pay a 1 year borrowing cost for, and then that ultimately has to be repaid back at market. So having lost control of global price setting in period, it enforces a new discipline is being forced on the old guard silver cartel, which while Western fixed foreign exchange silver is not Basel III compliant, it's also forcing local London LPMCL silver to ultimately also to become physically deliverable, even if it means borrowing it to pay it back, digging a deeper hole. Regardless, these lessors are then forced to hedge deferred exposure in Shanghai, forcing an ever series of higher physical prices. Also, because underpriced COMEX silver is able to be exchanged for physical from the COMEX into London at higher prices, it can no longer just be laid off in an unallocated form, also forcing the COMEX to become physically compliant by default. Now, new percentage-based margin requirements that were instigated yesterday may ultimately require 100% backing for a COMEX position, but not until the Fed repays billions in underwater Office of the Comptroller listed unallocated bets, which are identifiable and there, which are in the SGE's crosshairs every single day, just based upon the effect Basel III has had on FX gold, a similar 162% rise of literally forcing physical backing would price silver at $144, which is very close to our first pit stop equilibrium price of $140. And with CTAs still on the sidelines and having to engage at prices approaching $100, in very short order, silver will have to move into a much higher real supply-demand equilibrium, higher price. That is what we're saying.
What you've just heard isn't a price prediction in the usual sense. It's a description of structural pressure, the kind that builds quietly for years and then releases far faster than most people expect. Because when markets move from synthetic pricing toward physical settlement, the adjustment doesn't happen smoothly. It happens through gaps, shortages, and sudden repricing. And that's the common thread running through everything Andrew explained. Not speculation, not sentiment, but the steady migration of liquidity away from paper promises and toward fully allocated metal. That's why these price levels keep failing to bring meaningful supply to market. That's why volatility keeps appearing at the same calendar windows. And that's why what looks chaotic on the screen may actually be the system attempting to hold together under growing strain. Whether or not gold reaches the numbers discussed, and whether silver moves in stages or all at once, the more important takeaway is this. The mechanism that used to suppress price is being forced to operate under rules it was never designed to survive. And when that happens, markets don't respond gradually. They reprice. Now, everyone's situation is different. Some people hold physical metal, some hold paper exposure, some are still deciding how they want to position themselves at all. That's why I'd really like to hear from you in the comments. Are you focused on long-term wealth protection? Or are you still approaching gold and silver primarily as trades? And do you believe the difference between physical ownership and paper exposure is becoming more important now? Or do you think the system still has years left before that distinction truly matters? Share your thoughts below. These conversations help everyone watching think more clearly about their own decisions. And if you found value in this breakdown, please remember to like the video and subscribe to the channel. It genuinely helps this content reach others who are trying to make sense of what's unfolding. As always, stay informed, and I'll see you in the next one.